In this week's market update, nervous investors see the US as a safe haven as Trump plays the great disruptor, all eyes on earnings season, and Jay Powell shines a light on the Fed's interest rate strategy. Reading the headlines over the past week or so, you might be surprised to see stock markets flying high. Donald Trump's tour of Europe has been likened, for good reason, to a wrecking ball. He's undermined NATO, deepened global trade tensions, stuck an unwelcome nose into Britain's Brexit crisis, and cozied up to Russia's President Putin just days after 12 Russian intelligence officers were charged with hacking Hillary Clinton's presidential campaign. And what's the market reaction been to this political chaos? Well, far from running for the hills, investors have flocked to the source of the turmoil, treating the US as the ultimate safe haven, despite it being the cause of many of the concerns. The S&P 500 index rose above the 2,800 mark for the first time since early February, outperforming other world markets in the process. In the first 18 months of Donald Trump's presidency, the US market had basically mirrored the performance of the broad global market, but since then it's risen by more than 10% while the rest of the world has gone backwards. Something similar has happened in the US government bond market. US Treasury yields, which rise when prices fall, had reached 3.11% on the 10-year bond by May. Since then, the yield has fallen back to 2.83%, as investors have viewed the safety and relatively attractive income of US bonds as a port in the storm. The two are related, of course. Lower bond yields make the valuations on shares look increasingly attractive, but there's something else going on as well. As uncertainty rises, investors look to invest in higher quality investments and to chase growth where it's most reliably available. Increasingly, that has meant the US, and specifically the US technology sectors. At the same time, trade tensions, while not good news for American companies, might be worse for their counterparts in other countries. Someone like Germany is particularly exposed to falling demand for exports, which just serves to make the US look relatively compelling to any investors with a broad international remit. It's not hard to see why investors should be looking for safety. Having kicked off a trade war with China, Donald Trump ratcheted up the pressure last week with tariffs on a further $200 billion of Chinese imports, adding to the $50 billion already in America's sights. That was before the president left jaws on the floor at NATO's summit, when he effectively threatened to withdraw support for the key Western defence coalition against Russia unless European countries promised to pay more into the joint kitty. And that was in turn before he arrived in London to insult both Prime Minister Theresa May and the Queen. And hot on the heels of that, he travelled to Helsinki for a love-in with Vladimir Putin, whose protestations of innocence over the 2016 hacking charges the president has chosen to support in the face of compelling evidence from his own security services. Even by the standards of Trump, this has been quite a week. Apart from America's safe haven status, another reason why investors are gravitating towards the US market is the higher rate of growth being demonstrated by its biggest companies. After a stellar first quarter, earnings are expected to moderate slightly in the second 3 months of this year, but frankly not by that much. Earnings season, which kicked off at the end of last week and gets into full swing this week, is forecast to deliver profits growth of around 20%. That's still a fantastic result for investors. Around 60 of the 500 S&P benchmark constituents are due to report this week. Compared with the first quarter, the focus is expected to be more on fundamentals and less on tax cuts, although these will still account for about a third of the second quarter gain. That means, of course, that 2/3 is down to better performance, and a lot of this is down to revenue growth and not cost cutting. Revenues are expected to be about 8% higher year on year. Also in the spotlight this earnings season will be commentary about the trade tensions. This will be quite sector specific, with attention focused on car makers, who may struggle to pass on tariff increases to customers, and on retailers. It would also be worth looking out for cautionary comments on business investment, which could threaten future earnings growth if companies hold back. And the final thing to watch carefully for is forward guidance on profits for the rest of the year. 2018 is a rare year in which all 4 quarters are expected to see growth of 20% plus. If the third and fourth quarter estimates start to dip below that level, then it might be an early sign of the recovery rolling over. That would be bearish for a market with high expectations. The vulnerability of the most highly rated parts of the US market was actually illustrated on Monday by Netflix, which saw its shares tumble by as much as 14% in after-hours trading as it announced subscriber numbers about 1 million below Wall Street forecasts. Nervousness in the equity market chimes with fears that the bond market is sending a worrying message about the possibility of recession before the end of next year. The signal of this is found in the relationship between short-term bond yields and those on longer-dated issues. Specifically, if the yield on bonds maturing soon rises above that on longer-term paper, it's called an inverted yield curve in the jargon, then this can be a sign of trouble ahead. Currently, the difference between the yield on the 2-year bonds and those on the 10-year bonds is just 0.25%. This implies concerns about future growth in the economy further out as higher interest rates squeeze activity today and raise the value of the dollar, which makes life harder for US exporters. The other implication of lower medium and long-term bond yields is that the market is less confident that interest rates will remain on an upward trajectory than the Federal Reserve, which sets the rates, is. We should get some insight into the outlook for rates this week when the Fed's chairman, Jay Powell, gives his half-yearly testimony to Congress. The Fed's report that precedes that appearance and was delivered on Friday presented an upbeat assessment of the health of the US economy. The central bank said the labour force participation rate is increasing as households see jobs as plentiful and employers struggle to fill vacancies. It also said that business investment is stronger and that inflation is on track. The financial sector, the Fed said, is more resilient than it was before the financial crisis and is therefore able to cope with a rise in corporate debt levels. Now, on this side of the Atlantic, when we weren't watching Donald Trump in amazement, we were looking with equal bemusement at the unravelling of the government's Brexit plans. Following last week's cabinet resignations and Donald Trump's accurate observation that tying ourselves to EU rules precludes a trade deal with America, the attention has shifted to Europe's reaction to last week's white paper, which sets out Britain's negotiating position. So far, the EU has maintained a polite silence on Theresa May's soft Brexit plan, but few observers really expect a positive engagement with a proposal that challenges Europe's red lines on the 4 freedoms: goods, services, capital and people. Almost certainly, the EU will conclude that Britain is cherry-picking again, seeking free movement on goods and capital while trading access in services for the right to limit free movement of people. It's almost certainly a non-starter. The publication of a 98-page paper has pleased almost no one. Brexiters see it as a craven surrender to Europe. Remainers wonder what the point of leaving might be if we lose influence on rule setting, give away our leadership in financial services, all for the sake of staying in a revamped customs union that we already have access to. Surely, they argue, it's better to stay in and have a place at the table. Well, the market reaction has been neutral to negative. The pound's fallen back to close to its low point for the year at around $1.32. No one really knows where we go from here. A no-deal exit, further concessions before an even softer Brexit, a people's vote or a general election. None of these seems particularly appealing. Perhaps the most likely result is that the can is kicked even further down the road, with next March's exit day being postponed while all sides work on an elusive solution. And finally, the flip side of America's role as a safe haven is growing risk aversion towards emerging markets. Funds investing in the developing world have seen the longest streak of outflows in 2 years, with $17 billion now leaving emerging market investments in just the past 10 weeks. The MSCI Emerging Market Index is 12% below its March peak. Investors are worried about a cocktail of concerns for the asset class. Trade wars, of course, top of the agenda, but so too are US interest rates, the rising dollar, and high debt levels.